Chapter 31, fiscal policy. When we talk about fiscal policy, we're talking about the use of taxation and subsidy. That's government. Government using taxation and subsidy to correct or to manipulate the economy. So go down. Policy instruments. The government can use a number of tools to help achieve its macroeconomic objectives. These are called policy instruments. Policy instruments are economic variables such as the rate of interest, rates of taxation, the levels of government expenditure. The government can adjust them directly or indirectly. Changes in policy instruments can affect other variables in the economy, such as aggregate demand, inflation, unemployment, and GDP. For example, if the government increases income tax rates, there's likely to be a fall in aggregate demand because people will have less disposable income to spend. So there's these policy instruments. These are tools government use in implementing their macroeconomic objectives to achieve them. So they could use fiscal policy, monetary policy, supply side policy. All these are part of government policy instruments. So, but the focus area, I think, is fiscal policy. So one important policy instrument is fiscal policy. This involves adjusting levels of government expenditure and taxation to influence aggregate demand in the economy. So fiscal policy, are you there? Fiscal policy can be used to influence the behavior of firms and individuals. For example, many governments place heavy taxes on cigarettes to discourage the consumption of these harmful products. It is harmful product because it is a demerit good. Every year, the government plans how much it is going to spend on each category of expenditure. The government also chose how the money is going to be raised and states how much it plans to borrow. These are financial plan. We call it budgets. So government always have a budget, which it states its expected revenue and expected expenditure. So, and you know what fiscal policy is about? It's the use of government spending, which is subsidy or taxes, to correct or to achieve macroeconomic objective. Go down. Government revenue. The main source of revenue for a government is taxation. Governments all over the world impose taxation for the following reasons. Why do governments impose taxes? Number one, to pay for public sector services, to finance public services. Two, to discourage certain activities, especially those that are, that brings about social costs. Government wants to discourage it, to reduce it. Taxes can be used to help to control aggregate demand in the economy. This is discussed in more details, okay? Also, government can use taxes to correct inflation due to aggregate demand. The government wants to stop aggregate demand, to reduce it. Distribution of income, which we just finished now. Government can use taxes to reduce the gap between the rich and the poor. Clear? Direct taxes. These are taxes levies on income earned by firms and individuals. That means we're talking about taxes that I pay as an income, as an employee, or taxes your company pay because it makes profits. This is what direct taxes is. There are other direct taxes like inheritance. It's another example of direct taxes. So let's read anyway. Most government taxes fall into two categories: direct taxes, which are taxes imposed on firms and individuals. They are usually linked to income and wealth. Some of the key direct taxes used around the world are outlined below. One, we have income tax. This is tax you pay as an employee. Social insurance tax. This is tax you pay for your health care. Corporation tax, taxes on profit. Capital gain tax. These are taxes you pay for the fact that you are selling some of your assets. Capital gain tax. Inheritance tax. I mentioned that earlier. Taxes you pay for what you have inherited from your parents or grandparents or your uncles or whoever you inherit from. These are direct taxes. Clear? We go to indirect taxes. Indirect taxes are taxes on consumption. Are you with me? Taxes on consumption. So any tax on spending is an indirect tax. Now spending is consumption too. I think you know.
So spending is indirect tax.
Yeah, taxes on consumption.
Taxes on consumption, like consuming.
Yeah, spending.
Services.
Yes. So example of indirect tax is a value-added tax, ad valorem tax, VAT. So sales tax are taxes on spending. For example, you VAT. So you pay VAT. When you check your receipts, maybe when you buy tickets, airline tickets, there's a place to write VAT. You have to pay. VAT is the percentage of all your items. You have to pay certain percentage of all the items.
Like 20.
They add it up to the total price you have to pay. So government, the firm or the airline will be the one to remit it to government's account. Clear. Duties. Duties are often heavy taxes on select range of goods. In some countries, goods such as petrol, cigarettes, and alcohol attract quite heavy duties. Duties are also taxes, but you pay it on certain goods selected by government. Then we have custom duties. These are taxes on imported goods. Clear. Council tax is a collection of local authorities to help pay for local services, such as refuse collection and the rest. These are local taxes. The municipality. Business rates. For retailers, they have to pay taxes to the local authorities too. For taking care of, for security and for the rest. Then stamp duties. These are paid for, maybe you have to acquire some assets. You have to pay stamp duties. So government, sometimes you have to do your change of ownership and the rest. So government, there should be stamp duties that says, okay, now you have paid, that individual that is buying this asset, has notified the government about it. So you're not just going to notify government. You have to pay certain administrative charges to government in form of stamp duties. Clear. Then we have environmental taxes. These are designed to protect the environment. Below are some examples. Landfill tax is imposed on the disposal of waste in landfill sites. The charge is usually linked to the weight of the waste dumped in the landfill site. So you pay landfill tax. For those that are the refuse collectors, they dump it in the land. They dump it in the landfill. So how much you are dumped, the quantity will determine the amount of money you pay. So if you are dumping more, you pay more. Climate change levies are used to help countries make their commitment to reducing greenhouse gases. It is paid mainly by the suppliers of electricity, gas, and coal. So here they pay you because you are making sure that the environment continues to be green. Aggregate levy is a tax on sand, gravel, and rock that is dug from the ground. The tax is designed to reduce the environmental damage caused by quarrying. This is from the quarry. They need rocks, limestones to build. So you have to pay taxes for this. We call it aggregate levy. Clear? Any question about that? We move on. Government expenditure. This is government spending. So, in government budgets, there's revenue and there's expenditure. Total planned expenditure and the amount to be spent on each category is announced every year in the budget. That is what the budget is about. I'll just go down, sorry. There's nothing I have to explain. I think you understand what government expenditure is. The amount of money government is going to spend. It's not always going to spend, it will be based on its budget. So there's a budget, government spending is about government expenditure, which will be part of the values that has been written down in its budget. We go to fiscal deficit and fiscal surpluses. Fiscal deficit and surplus are mostly, we could call them budget surplus or budget deficit. So what is fiscal deficit? In most years, when government plans to spend more than they receive in taxes, in tax revenue, this results in a fiscal deficit and means that government must borrow money to fund the deficit. So for fiscal deficit, it means government is spending more than what it's receiving in terms of taxes. So that means government revenue from taxes is less than what government is spending. Okay. All right, that is fiscal deficit. And for fiscal surplus, it means government revenue from taxes is more than what government will spend on taxes, or government will spend from taxes in terms of expenditure. Is it clear? That's fiscal expenditure, surplus, sorry. So the impact of a fiscal deficit and fiscal surplus. Over a long period of time, most governments would prefer to avoid running a fiscal deficit. In a year when the government plans to overspend, it will have to borrow money to fund the deficit. Consequently, if deficit builds up over a period of time, the national debt gets bigger and bigger. This means that the government is asked to spend more and more of its revenue on paying off the debt. Many would argue that money spent on interest payments has a high opportunity cost. For example, the money could be spent on lower taxes or extra spending on social provision or infrastructure development. The consequence of fiscal deficit. Fiscal deficit means we are spending more than what our budget is in terms of taxes that we're going to receive from revenue. So if we are doing this, we are spending more. We have to borrow to meet up with this spending, yes or no? So borrowing to do this means that we have to pay interest on borrowing. Paying interest on borrowing is high. It becomes an opportunity cost because the interest we pay on borrowing should be used on infrastructure, on other social benefits, on education that will make the society a better place. That is the consequence of fiscal deficit. Is it clear? For fiscal surpluses, this means we have more in revenue than what we are going to spend from the tax revenue. So the impact of a fiscal surplus is likely to be positive. If a government collects more revenue than it spends in a year, the surplus could be used in a number of ways. For example, it could be used to spend on the future provision of public services or used to lower taxes in the economy. So because government is making more now, government could cut taxes. And if government is cutting, for example, income taxes, this means disposable income increases. And that would increase the purchasing power of households, improving their living standards. That's the point there. Is it clear? This would reduce future interest payment. Okay. However, most government would use it to pay off some of the national debt. So government might also use it to pay off their national debts. So as a result of that, the interest government has to pay on debt reduces. That increases the balance of payment of the country, which is good. Finally, when analyzing the size of fiscal deficits, it is more important to focus on the size of the deficit in relation to the nation's GDP. This is because the amount that needs to be borrowed to cover the deficit is only a serious problem. If it is a large percentage of the GDP, it is like an individual taking out a loan. If an individual has an income of 80,000, a 5,000 loan is fairly easy to pay back over a few years. However, someone earning just 15,000 a year may struggle to meet the interest and loan payment of 5,000. This is because the loan is equal to 1/3 of the person's annual income. It might be quite a burden. Therefore, when analyzing fiscal deficits and making international comparisons, it is best to expect the deficit as a percentage of GDP. So the point is this: fiscal deficits might not be a problem if you have a high GDP. But if your GDP, the GDP of the country is low, the burden is more, then it becomes a problem. So when you are analyzing the fiscal deficit, analyze it based on your GDP. So if it is based on the GDP, then you will be able to know if the country is on the safe side or not. Is it clear? Any question about that? The impact of fiscal policy on macroeconomic objective. You know, we said government objective is about, one of government macroeconomic objective is to expand, is for economic growth. So let's see what they are talking about. He said, fiscal policy is also used to influence aggregate demand in the economy. In some years, okay. In some years, a government may increase the size of the budget deficit or reduce the surplus by spending more or taxing less to stimulate the economy. This is called expansionary fiscal policy. So we have expansionary fiscal policy and we have contractionary fiscal policy. What makes them differ? I'm just going to explain that. For expansionary fiscal policy, it means government is trying to increase its spending. And if government is trying to do this, government is trying to increase aggregate demand within the economy. So if government wants to increase aggregate demand within the economy, government will use expansionary fiscal policy. Did you get expansionary there? Yeah. Then, if government wants to reduce, aggregate demand in the economy, government will use contractionary fiscal policy. So I think you understand the difference between expansionary and contractionary now. Expansionary is about increasing aggregate demand. If government wants to increase aggregate demand within the economy, government will use expansionary fiscal policy. Example is reducing taxes, increasing subsidy. These are expansionary fiscal policy. Taxes, let's talk about tax here. Expansionary fiscal policy is to reduce taxes, increase subsidy. That is expansionary fiscal policy. If government wants to reduce aggregate demand within the economy, government wants to stop consumption, reduce consumption within the economy, maybe because there's inflation, government will use contractionary fiscal policy. Government will increase taxes, reduce spending. Clear? Is it clear, please? All right. Inflation. Contractionary fiscal policy can be used to reduce inflation. I just explained that already. Because inflation is a percent rise in the price of goods and services caused by increasing aggregate demand. So for aggregate demand to reduce, government will use contractionary fiscal policy. Inflation would reduce. Clear? For economic growth, if government wants to, now we're talking, do you know what we're talking about now? We're talking about the impact of this fiscal policy, either expansionary or contractionary. For inflation, government will use contractionary policy. For economic growth, government will use expansionary fiscal policy because at that point in time, government wants to encourage aggregate demand. Government wants to increase aggregate demand. To do this, government will spend more, cut taxes. If government is cutting taxes, government will cut corporate taxes. Profit will increase for firms. Firms will be able to expand. In the course of expanding, firms will be able to employ more workers. Employment will increase. Income will increase. Aggregate demand will increase. That's for economic growth. Is it clear? Unemployment. Especially fiscal policy can help to reduce unemployment. Again, increase in government expenditure and tax cuts. So for unemployment to reduce in the economy, government will use expansionary fiscal policy, which means government will reduce taxes, government will cut taxes, increase spending. Clear? For current account deficits, fiscal policy might be used to help influence the balance of the current account. For example, if there's a large deficit on the current account, contractionary fiscal policy would help to reduce aggregate demand. This will help to reduce the demand for imports. So, if government wants to reduce balance of payments, current account deficit, government will cut taxes. Government will increase taxes. Government will increase taxes on importation. So if government increase taxes on importation, importation would reduce. Imports will be less. People will focus on domestic products. As a result of that, the balance of payments will improve. Is it clear? Fiscal policy and the environment. More recently, government have used fiscal policy to tackle environmental problems like taxes. So government will come up with taxes, increasing taxes on landfill tax, all pollution taxes and all the pollution permits, they will increase the prices and all these things to make sure that the environment is not damaged. Is it clear? So for fiscal policy and environment, government will use contractionary fiscal policy. Is it clear? Any question about it? Okay, we'll go to the activity, the MCQ. In 2016, a government spent 654.5 million and collects 631.6 million in revenue. As a result, the fiscal balance of the year would be which of the following? Yeah, it's to get the budget is revenue minus. You have to know the formula. It is government revenue minus government revenue minus government spending. So government revenue is 631.6. Government spending is 654.5. So what's the formula? What's it? It should give you a deficit. It should be 22.9. That's the lowest formula. It should give you a deficit. Negative. Yeah, I said it is revenue minus government revenue minus government expenditure. That is the budget. Revenue minus expenditure. Revenue is 631.6. Expenditure is 654.5. Is it negative or not? Yes, negative 22.9. And that is what? 2.29 million deficit. D. Is it clear? The next one. Which of the following fiscal measures is likely to increase a fiscal deficit? Fiscal deficit. Why did you choose spending on education?
Because it's a fiscal deficit.
No.
I don't understand this question.
But why did you choose A? My point is, guess, please don't always guess. Fiscal measures, we said fiscal policy are government taxes and government spending, right? Education. For education, according to what we read, education does not give us the result on education is not is long term. You don't get the positive impact on education is a long term. Yes or no? Great. Now, if government spend more on education, The answer is A anyway, but I'm going to explain all the answers, all the options to you.
Yes.
An increase in spending on education, because education will not give us results right now. It's a long-term thing. It means government is spending to expect a future compensation which is not good for now. That increases spending.
Sure.
2, a rise in value-added tax. When government increases tax on spending, it is good because government revenue would increase. A rise in VAT will increase government revenue. That is not going to give you deficit. A cut in pension payments. If government cuts pension, it means government spending would cut. A cut in government spending would increase government revenue. That will not give deficit. A rise in corporation tax. A rise in corporation tax means government is getting more taxes or revenue from profits made by firms. That would increase government revenue. So the only spending here is education. And as a result of an education which is not going to give us a benefit of now, it's a benefit in the future, means government will continue to spend, hoping that the future becomes better for the population. So that increases, that might bring about fiscal deficit. Is it clear? VAT will increase income, revenue. Cut in pension will reduce spending, revenue increases. A rise in taxes for profit will increase revenue. Is it clear? Any question on? So that ends chapter 31, fiscal policy. And that ends the lesson.
It's A1. The answer is A.
Yeah, A, yes.